Welcome to the Riskwiser Zone, the podcast where we dive into the latest developments in the world of stocks and finance. I'm your host, Lewis, and I'm excited to share today's top story with you. We're coming to you live on a day that's seen some significant movement in the markets, all thanks to a major breakthrough in trade negotiations between the United States and China. After weeks of tension and uncertainty, it appears that both countries have reached a tentative agreement to slash tariffs for a period of 90 days. This is a development that has sent shockwaves through the financial world, with many analysts hailing it as a major step forward in the ongoing trade war. According to reports, the U.S. will temporarily lower its tariffs on Chinese goods from 145% to 30%, while China will cut its tariff on American imports from 125% to 10%. This reduction is expected to have a significant impact on the prices of consumer goods, including electronics and other products that are heavily reliant on international trade. The news has already had a major impact on the markets, with the S&P 500 futures rising by 2.8% in after-hours trading and the dollar gaining 0.7% against other currencies. Many experts are viewing this as a positive sign, suggesting that it could be a major turning point in the trade war and potentially pave the way for a more sustainable and mutually beneficial economic relationship between the two countries. However, it's also important to note that there are still many uncertainties surrounding this agreement, and it remains to be seen how it will play out in practice. Some analysts have expressed caution, pointing out that the details of the deal are still sketchy and that there may be challenges ahead in implementing the agreed-upon measures. As we delve deeper into this story, we'll be examining the potential implications for investors, consumers, and the broader economy. We'll also be talking to experts and analysts to get their take on what this means for the future of global trade and finance. So, stay tuned as we explore this breaking news in more depth. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're exploring the latest developments in the world of finance and risk management. In our previous segment, we discussed the impact of global trade tensions on market volatility. Now let's dive into a story that's making waves in the financial industry. A potential regulatory shift is on the horizon, and it could significantly alter the business models of Wall Street wirehouses and broker-dealers. The Securities and Exchange Commission is considering exempting certain exchange-traded funds from specific rules, which could lead to a surge in new ETF products hitting the market. According to a report by Cerulli Associates, this shift could result in wirehouses and broker-dealers losing between $15 billion and $30 billion in annual fees. These fees are currently collected from mutual funds offered to customers. The exemption would allow asset managers to create ETF share classes more easily, potentially leading to hundreds or even thousands of new ETFs. However, it's essential to consider the potential obstacles that could arise from this development. Distribution is a significant hurdle, as intermediary platforms might be less inclined to list these new ETF share classes if they stand to lose substantial revenue. This could limit the number of products that actually make it to market. It's also worth noting that some experts estimate that the actual number of new ETFs might be lower than initially anticipated due to these challenges. Mutual fund managers may be hesitant to add ETF share classes if they're unsure about distribution and acceptance by wirehouses. As we navigate this complex landscape, it's crucial to remain informed and adapt to changing regulatory environments. The potential impact on the financial industry is significant, and we'll continue to monitor developments and provide updates as more information becomes available. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had an exciting show so far, exploring the intricacies of the financial world and navigating the complexities of risk management. As we wrap up today's episode, let's take a look at some of the latest news from the business sector. We have three major stories that caught our attention. Firstly, the Canadian e-commerce giant Shopify is set to join the NASDAQ 100 index, replacing MongoDB. Incorporated. This development has sent Shopify's stock soaring with a 14% increase in just 1 day of trade. This move is a significant milestone for the company and reflects its growing influence in the global e-commerce landscape. In other news, Whitecap Resources Incorporated has completed its $15 billion combination with Veren, creating Canada's seventh-largest oil and gas producer. The new entity, operating under the Whitecap name, boasts an impressive portfolio of assets, including a significant presence in the Montney and Duvernay shale regions. With expected production of 295,000 to 300,000 barrels of oil equivalent per day, this merger is set to have a substantial impact on the energy sector. Lastly, we took a look at the residential construction industry, where the Ontario government has announced new measures to address housing affordability, and the news that the Residential Builders Group has warned about a significant decline in new home building due to increasing interest rates. It's essential to consider these developments in the context of the broader market trends and economic indicators. As investors, it's crucial to stay informed and adapt to changing circumstances to minimize risk and maximize returns. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.